call the meeting to order. Thank you for joining us for our weekly hybrid MLS breakfast meeting. My name is Earl Knudsen from Pinnacle Real Estate Group, and I am your July program chair. Please stand for the Pledge of Allegiance with Yolanda Martinez Arenas from WFG Time.
Good morning, everybody. Place your right hand over your heart and repeat after me as we honor our beautiful and wonderful country and flag. I pledge allegiance. Thank you.
Thank you, Yolanda. Thank you very much. And I would like to welcome up Mindy Ye from REMAX 2000 for our inspirational quote.
Thank you, Earl. Good morning, all. You know, today is Fool's, F-O-O-L, Paradise Day on 13th every year. July 13th, it is a day to forget the worst side of reality and embrace the fantasy world of our thoughts. To normalize this and ensure the importance of having a happy place to go to when things get dark and out of hand. In Fool's Paradise is made up world we imagine, a world where we find eternal happiness. Fool's Paradise Day is a day to embrace such a paradise and try to find happiness amidst all the tensions and pressure of the real world. With that, I would like to share this inspirational quote with you. No matter what you are going through today, don't quit. Don't feel defeat. You are doing the best you can. Remember, giving up is not who you are. You might pause, take a long breath, pivot, find solutions. Keep going.
And I might add, it's one of my favorite holidays. It's actually National French Fry Day. A little about me. My name is Earl Knudsen. I had to write it down. I can't even do my own. I'm married. My wife is named Premjit, if I can remember it. So I call her PJ. And she is Thai, and we live in Santa Fe Springs. I graduated USC in 1980. Yeah. I don't know. It was. I have a cinema film degree, so I don't know what I learned. Actually, but basically, my first job was KYCU TV in Cheyenne, Wyoming. And my second job later on was I was an on-air switcher for KUSA in Denver, Colorado. And later on, I returned back to California and I got my license and I started in 1984 at ERA Realty. And I was there for many years, but most of my career I spent with the gold coat on at Century 21. So that was the 70s. It was just the biggest office. I was a Centurion in 1998 for both residential and commercial real estate, which was a real peak. And in 2007, I started in management for Coldwell Banker Dynasty, later REMAX 2000 and United Real Estate and KW Executive, and I'm now at Pinnacle Group. Okay, that's me. Now back to my schedule. And if you are a member and would like to make an announcement, please go to this table. There is a form and turn it into Berlin. Thank you. A few housekeeping tips. All participants on Zoom will be muted on entering the MLS breakfast meeting. And should they have a question or want to make a comment, please remember to enter it into the chat box. Please remember to join us weekly as we have our hybrid MLS breakfast meeting every Thursday at 9 a.m. And as always, this meeting will be available online on our YouTube channel, West San Gabriel Valley Realtors. Please remember to follow WSGBR's social media on Facebook, Twitter, and Instagram. You can also watch our pre-recorded videos on YouTube and to join us for text messages on our text message group and updates from the board, text WSGBAR to the number 888-301-2201. Today's agenda consists of the affiliate spotlight featuring Brandon Lamb from Olympus Escrow. And we also today our guest speaker is Mr. Anthony Watson, a tax consultant with Robert Hall and Associates. And just a reminder that to be eligible for today's winning drawings, you must be a WSGVR member and be in person at the association. We will be having an attendance drawing and an Amazon gift card drawing and 50/50 raffle. Today, our affiliate spotlight will be brought to you by the affiliate committee chairperson, Lena Sang-Carey from US Bank, and Vice Chair Teresa Nguyen from Loan Direct. And now, Brandon, take it away.
Thank you, Earl. Hi, everybody. My name is Brandon Lam. I'm a escrow officer at Olympus Escrow. I'm 26 years old. I graduated from Cal State University of Los Angeles in 2021. Right after graduating, I jumped straight into escrow, and I've been there since. So a little bit about Olympus Escrow. We are located on First and Huntington. Our team is there to make sure that you succeed and that we all synergize really well. Olympus Escrow is an independent escrow. That means we're regulated by the Department of Business Oversight, which is one of the strictest types of regulation. Again, I started as an escrow processor in 2021, and the start of this year, 2023, I've begun my escrow officer journey. So besides the usual days at the office, I really enjoy dressing up for Halloween. So on the picture on the left, I'm Moss. So I even changed the picture on my desktop and everything to look like a baby. It's a nice photo. And on the right, I'm the Stay Puft Marshmallow Man from the Ghostbusters. When I'm not at the office, I'm out playing pickleball. Right, I play pickleball like maybe like 3-4 times a week. It helps me decompress, but I still feel really tired after, so I need to sleep more. On the top left, that's the indoor pickleball facility, and the other 3 pictures are at Barnes Park, Monterey Park, where I play very often. So if I'm not playing pickleball, I'm not at work, I'm hanging out with friends. We like going out to like bars and like drinking, and then we also like doing activities together. The bottom left photo, that one is at a bar in Hacienda Heights. Actually, both these photos are in Hacienda Heights. That bar is called Blossom. It's a Korean bar. It's really nice. And then the bottom right photo, that's at Round 1. That's a bowling alley. I'm there with friends. I have a pet bunny. His name is Nugget. He's very cute. I've had him for 2 years now. He's really adorable. I love seeing him running around the house. When I'm at home, he loves getting pets. When he's around the house, he likes to follow me around and everything. He's really adorable. But they have a lot of energy at night. So definitely at nighttime, before I go to bed, I have to let him run around and all that stuff. He's very food motivated. When I give him treats, he does this trick. I taught him this trick where he spins for his treat, but now whenever I come up, he spins on his own. I don't even know what. Yeah, I'm like, I'm not going to do anything. Yeah, that's my pet bunny, and I love him very much. So again, thank you so much for the letting me introduce myself. My name is Brandon Lam. If you have any questions or if you'd like to reach out to me, I'll be around. You'll see me around. Feel free to come up and ask. Hope to work with you all in the near future. Thank you so much.
Thank you, Brandon. Thank you very much. Please remember to support our affiliates with your transactions. We will now have our affiliate introductions for today. All paid affiliates present today, please line up at the front. Please, no promotions or announcements. This is a morning greet only. And we will begin with the affiliates in person.
Be the first one.
When you exit, please go to the right towards the door.
Good morning, everyone. Look at they're taking time to catch up to me. Got one person here caught up to me. I'm Cosmo Sanchez, and I am a mortgage lender with UA Funding. Thank you.
Good morning.
Good morning, everybody. Mackenzie Hom with Morrison Plus Property.
Close to the mic. Good morning, everyone. Yolanda Martinez Arena, WFG National Title Company. Have a wonderful day.
Good morning, Bob Chu with Champion Escrow.
Good morning, Sue Chong with Akaza Management.
Good morning. This is Function Master Alex. Thank you.
No worries, Ned. I remember going that way. Good morning, everybody. This is Mario, your black belt in reverse mortgages. Rate 1.9.
Good morning, everyone. Sage Gomez with my NHG. Have a good day.
Good morning, everyone. John Wax with SNAP NHD, Natural Hazard Disclosures. Stay cool today, stay hydrated, have a wonderful day, great weekend.
Good morning, everyone. Esther Chow with HSBC Bank, also represent Asian Real Estate Association of America Tri-County Chapter. Thank you.
Great morning it is, Eduardo Kikuchi.
Good morning, it's Angie Wong with Loan Direct.
Good morning, everybody. Lucia Tam representing CAREPA, Chinese American Real Estate Professionals Association. Have a full week, I hope.
Morning, everybody. Oriana Chan with Prime Lending.
Good morning, everyone. Brandon Spransky with First American NHD. Have a fantastic day.
Good morning, I'm Phoebe Liu from Visa Bank. I'm a local commercial home loan officer. You guys have a wonderful day. Thank you.
Good morning, John Sun from Budget Blinds.
He's gonna get smacked. Good morning, everybody. Nancy Chan, lawyer's title.
Good morning, Jeff Bird with Western Rooter Club.
Good morning, everyone. Alba Moy from Moy and Funaka. Have a wonderful day. Good morning, Alina Chu from Glen Osasco, the other restaurant company.
Hello again, Brandon Lam with Olympus Store. Have a nice day.
Good morning, this is David Tran. I'm here to break up the escrow chain.
Good morning, everyone. Jacqueline Chu from Champion Escrow.
And thank you to our affiliates. And now we will call on the affiliates that are joining us virtually. Sandy Franco, are you
Good
with
morning,
us?
everyone. Sandy Franco, First American Home Warranty. Have a great week. Stay cool.
Thank you. Teresa Lamb.
Good morning. So sorry about that. Good morning. This is Teresa Lamb with Corinthian Title. Have a wonderful day. Stay cool.
Thank you, Teresa. Yeah, just give us a moment when we had to unmute one and mute the previous one. Okay, Judy Chow.
Good morning, Judy, Senior Loan Officer. I'm outside. Have a great week and stay cool.
Thank you, Judy. And Mark Wu.
Good morning, everybody. Have a delightful caravan. I can still offer insurance, even though many companies can't. Yes,
Thank you, Mark. Yeah, thank from Bravo. Thank you, Mark. And that's our affiliates. For those of you that came in this morning, you might have saw to the door, there is an item on the table, and the WSGPAR Foundation is doing a silent auction each week. Please go to the table and see if you can use that item in your kitchen and make a good bid on it, okay? For the silent auction. Hey, thank you, Lorraine. Okay, we are happy to include open pitching to our hybrid MLS breakfast meeting. Reminder that if you would like to pitch your listing now, at this time, we're going to introduce our guest speaker, Mr. Anthony Watson. And let me just go over his bio just a moment, Tony. Tony Watson personally manages clients with over $350 million in real estate holdings. He has spoken for hundreds of trade organizations throughout the state of California. He's holding a federal license as an enrolled tax practitioner. Tony can advise, represent, and prepare tax returns for individuals, partnerships, corporations, and any other entity with a tax reporting requirement. Aside from his full-time position at Robert Hall and Associates, Tony is an active real estate investor and entrepreneur and enjoys short and long-term trading. With over a decade and a half of experience, Tony, along with his team at Robert Hall and Associates, actively look for the newest and most up-to-date strategies to implement on tax client filings. They are all operate with the same goal in mind: to help taxpayers keep more of their wealth and not overspend with federal and state revenue agencies. Please welcome Mr. Anthony Watson.
Thank you so much for having me back. It's been a while since I've been back to this location. I remember pre-pandemic, it was once every quarter or so that I was here. So if you've seen me speak before, you know I'm the crazy tax guy who really likes what he does and likes teaching people about what is not the most exciting topic to discuss, but that's the wonderful world of taxation. All right, so today's topic, near and dear to my heart as not only a real estate investor, but also a self-employed business entrepreneur. Aside from my job at Robert Hall and Associates, my wife and I both own separate entity corporations that we have some businesses run through. So today, I'm not only going to be talking to you about the power of incorporating from a business perspective, but also from a personal perspective, practicing what I preach in this case, and other wealth retention tips as well. I've added a couple slides regarding cost segregation. I don't know how many of you have heard of cost seg before, but it has become a very popular election, specifically over the past 4 to 5 years. I've been working with Robert Hall for almost 2 decades. And I can tell you right now that during the pandemic years, I individually in my column of clients filed more cost seg elections in that 4-year period than collectively over my 20-year career at Robert Hall. So I wanted to add that to the PowerPoint today, even though it doesn't really have anything to do with PowerPoint. I just wanted to whet your palate, so to speak, on the topic of cost segregation. Thank you for the introduction. I think that $350 million number was a little out of date, so I wanted to update you with this. In my clientele roster, I think we're at well into the 500 million managed real estate and other business dealings. So I see a lot tax-wise. Our firm sees a lot. We had some significant growth during the pandemic, naturally, because most accountants who were one-person operations in LA County who couldn't switch over to the digital platforms quickly enough, they decided to enter into early retirement. So we were able to pick up a lot of business from the unfortunate situation and scenario that we all saw during the pandemic years. Once again, I'm going on about 2 decades of service with Robert Hall and Associates. I am not only an active tax practitioner and tax preparer, but I am the keynote speaker for our firm as well. Prior to the pandemic, on average, we were doing about 30 events per year, free education seminars, in-person seminars. And because of the digital platform of Zoom, like we're doing today, and also in person, we're averaging about 140 free educational seminars and webinars on an annual basis. And I've been able to add 1 more keynote speaker to the roster, Nicole, with our office, who is absolutely fantastic. So if you are interested in educating yourself more outside of this in-person seminar today, I will give you our information in a couple slides here, and you can sign up for those free educational webinars and all of our email blasts that we send out. I by no means am a one-man operation. I work alongside a wonderful senior consulting staff. We have about 55 employees at our firm, and we service tax filings in all 50 states. That's something that's very unique about our firm. Only 1 location in beautiful Glendale, California, but we actually do service over 10,000 tax filings in all 50 states, or across all 50 states. Won a couple awards in the Glendale area, best accounting firm, Reader's Choice Awards, so on and so forth. And overall, as a firm, aside from my clientele roster, I think we are well over 1 billion in real estate operations and management. So like I said, we see a lot. 1031 exchanges, cost segregation elections, deferred sales trust, Delaware statutory trust. I mean, you name it. If there is a scenario that we haven't heard of, we'll obviously educate ourselves on it, but I would test us on that, because we tend to see a lot more than the average accounting firm in the Los Angeles area, if not in the California area, when it comes to real estate and small business. And we've been around since 1971. We've been 50 years. I will show you this at the tail end when we do question and answer, the Q&A section, but this is probably the best way to engage in the Robert Hall services. We do offer a free consultation, 30 minutes, either in person or over the phone, just to see if we're the right fit for you. There is no hard sell on our end. We know what we're capable of doing. And if you are not happy with your current tax professional or CPA or your pope or your priest, whoever does your taxes, whoever you trust with all of that, then come and try us out. If anything, you probably want to sign up for this just to be on our free educational webinar email blasts. Whether or not you're thinking about switching over, that's a different story, but this is the best way to also learn about our upcoming free events. All right, jumping right into it, let's talk a little bit about if incorporating is right for you, because I want to start off by saying incorporating is not right for everyone. I don't want all of you to leave today thinking that, oh, this crazy tax guy told me I should leave this seminar and go and start an LLC or incorporate myself as an S Corp or a C corporation. There is very much a right and a wrong time to incorporate. We have to interview our clients. I call it the interview process. It's really just a consultation, but I have to interview my clients, both current and new clients, to make sure that I am advising them and pushing them in the right direction when it comes to incorporating. The Q&A section session that I have with my clients, this interview, basically boils down to 3 questions. Number 1, what personal assets do you own? Do you own a primary residence? Do you own rental investments? Do you have inherited investments? Do you have brokerage accounts? What valuable assets do you own personally that are attached to your primary social security number? Because the number 1 benefit, the reason why this is the first question I ask is the number 1 benefit of incorporating is not going to be the tax benefit. We'll get to that in a second. The number 1 benefit of incorporating is asset separation. It's meant to separate your business assets from all of your personal liabilities. So asset separation equals asset protection. If I ask you, what do you own personally? And you tell me that, well, I don't own a home. I don't have any rental properties. I just started my 401k. It's got 10 grand in it, right? I don't have any valued assets attached to my social security number. Well, incorporating might not be right for you based on the liability protection aspect. But incorporating might make sense because of the revenue that you're bringing in and the profit that you're showing. And maybe there's another benefit outside of the asset protection benefit if you're not going to receive that right out the gate. So let's assume that you do own a home, that you do have these assets. So we check yes to question 1. Question 2 is, what is the consistency of your net profit? Because one job that a tax professional and accountant has is to make sure that we don't tie you into an obligation, financially speaking, with the state of California, that costs you more than the incorporated entity is saving you on a year-to-year basis, right? Why would you ever want to tie yourself into a contractual agreement with the state of California where you're paying them more than what this entity is actually saving you in income tax yearly? So question number two is, what is the consistency of your net profit? And the number that I am looking for to be consistent over a 2-year, or maybe right out the gate, to making hundreds of thousands of dollars. And if that's the case, then it doesn't matter if it's consistent. We just need the incorporated entity as soon as possible. But I'm looking for consistency in net revenue, this milestone net revenue of about $40,000 to $45,000 in profit. This is not your gross commission income. It's not the total money that's coming into the account. It's the money coming in minus all of your expenses, whatever that bottom line net profit is. That number, it needs to be at least $40,000 to $45,000 in order for an incorporated entity to save you more than it costs you in California filing fees, in tax preparation fees, so on and so forth. So financially, it needs to make sense. That's question 2. Normally, we can advise to move forward based on question 1 and question 2, but if question 1 and question 2 are no's, where your revenue is not there, you don't own personal assets, question 3 is about risk and liability. What level of risk and liability do you operate out within your industry? Well, I know the risks and levels of liability for real estate professionals, but let's say that you or a family member or a coworker are starting a business that isn't in the real estate industry, maybe a skydiving instructor business. I use this example all the time, where you haven't started your operations, you haven't acquired a plane, you haven't acquired a hangar, you haven't gone through the insurance side of the business setup, but you are starting this business. You know for a fact that maybe you're a veteran and you have a number of hours of jumping out of planes with parachutes, and this is the business that you want to start. Well, if you think about it, who has more risk and liability in their industry? You as a realtor or a real estate professional versus a skydiving instructor, right? Kind of silly to think about. This person is strapping somebody to their chest and jumping out of a plane miles in the sky, right? I mean, that there's somebody's life in balance. And so we might incorporate that individual simply because of the liability and risk moving forward as they start to build their business. But we need these 3 questions answered before we advise to take the next step to incorporate. So once again, just to reiterate, incorporating is not right for everyone. Do not leave here and start that entity without talking with your trusted tax advisors, with your attorneys, with your priests, once again, whoever you trust with that financial information. If incorporating is right for you and you have that milestone net revenue of $40,000 to $45,000, which type of entity should you choose? Because the most common types of entities that we all know of are the LLC, the C corporation, and the S corporation. There are other entities like LPs and LLPs, and then there's this new type of entity called a B corporation. How many of you have heard of a B corporation before? Okay, so B Corps aren't actual entity structures. You elect for a C Corp or an S Corp to be not taxed, but recognized as a B corporation. It has been part of this whole Green Book initiative under the Biden administration. You know, everything's green nowadays with the EV vehicle credits and the solar panel credits, all of that. They're really trying to change things for the betterment of the environment. And so a B corporation is actually not a license, but an application to show the government, hey, I operate at the highest level of environmental efficiency as I possibly can. My building is energy efficient. I use organic products. I don't produce products where they also produce nuts or have dairy or anything like that. I mean, there's a whole lot of things that are hoops that you have to jump through in order to qualify as a B corporation. But the most common entities are the LLC, the C Corp, and the S Corporation. Those are the income tax entities. The LLC, just straight out the gate, will not save you anything in tax, okay? So if you've read an article online, if you've watched a YouTube video, be very careful with what you watch on YouTube these days, because those individuals who are recording these 15, 20, 30-second videos telling you should go out and buy a car and lease it to your corporation, and all of these crazy ideas that they have, if you don't see a license number on that video, take that information. I'm not saying don't educate yourself, but take that information to a licensed tax advisor and just run that scenario by somebody who is licensed to advise on this. I can't tell you how many emails, how many calls, how many consultations I get nowadays simply because of a 30-second YouTube video. And I love it. I love the fact that people are really finding importance in educating themselves when it comes to income taxes and filing certain ways, but there's a lot of misinformation out there. All right. So if you see something online, you see something, say something, right? If you see something online, take it back to your tax advisor and just run the idea by them. I've heard a lot of great advice online that I could back up with further education. But then I've also equally heard as much bad advice online as well. So just be very careful. The LLC, if you hear that it is an entity that will save you tax, that is not the case. The LLC does exactly what it's meant to do. It limits liability, and that's all it does. That's why the LLC is most importantly used, or as an entity structure, most importantly used to acquire title to investment property under. You go out and you buy your first rental property, or if you have rental investments and you find that coming out of the pandemic, you've increased rents, there's a little bit more risk and liability in what you're doing as a property owner. Your tenants aren't the nicest of people to deal with, so you want to make sure that you're protected up, down, left, right? And so the LLC is going to be your go-to entity structure for liability protection on that investment. I'll get to why you don't want to put property in a corporation in a couple seconds here, but the LLC is going to be the most commonly used entity for property title. And once again, it does exactly what its name tells. It limits liability. It's meant to separate that property from all of your personal risks and liabilities as you operate just on a day-to-day basis as you, a United States taxpayer. But it's not going to save you any tax. Now, the C Corporation, which is a completely separately filed tax return, completely separately held entity outside of the LLC, once again, it's connected to you individually still from a tax filing perspective, but it does give you that liability protection. A C Corporation is actually a completely separate tax return. It has no connection with you personally whatsoever, unless you pay yourself a W-2. And at that point, you're just an employee of your own corporation. But there is nothing tax-wise or financially tying you to this corporation. That's one of the major benefits on the anonymity side of things for a C Corporation. C corporations in the tax industry are referred to as double taxed entities. And this is where a C corporation might not be right for you. C corporations not only pay a corporation tax at 27% federal, 9.3% state, whatever the profit is under that business. But then if you draw money from the C corporation, you pay a dividend tax on the personal tax return. So we refer to it as a double taxed entity. There are some businesses out there like the eBays of the world, the Amazons, the Googles, the Teslas of the world. They are required to file as C corporations because they have over 100 shareholders. And more likely than not, because they're publicly traded. But you can have an S corp that's publicly traded, but once again, if you have over 100 shareholders, you are not allowed to file as an S corp. So the C corporations are mostly for larger entities. There are very unique scenarios where a C corporation might make more sense than an S corp or an LLC, and I'll give you a couple examples. Let's say that you are claiming a dependent on your return that is a child or a parent that needs medical assistance, right? In-home care. I had a client who had to build a whole wing onto his house, and make it like sort of like a separate hypoallergenic chamber because the child had crazy allergic reactions to things. And so that was a medical improvement to his property. So if you are that individual who has somebody who requires a lot of medical costs on an annual basis, a C corporation might be the right route for you. Because out of all of the entities, the LLC, the C Corp, and the S Corporation, the only entity that allows for 100% medical deductions for you, the owner of the corporation, and your dependents is the C Corporation. So as you can imagine, let's say you're paying $90,000 a year for assisted care costs for a parent that you're taking care of or a child. On the individual return or under an LLC or an S Corp, that $90,000 expense is significantly limited, meaning that the first 10% of your personal income and medical costs isn't even a write-off. So you lose a large chunk of that deduction right out the gate. A C corporation allows you to fully deduct the 90 grand dollar for dollar against self-employed income. So once again, we need to sit down with our clients and figure out what entity structure is right for them. The LLC, no tax savings, C corporation may be right for you, but really depending on a few unique scenarios that might apply in your situation. The S corporation is the holy grail of entity structures. In fact, the S corporation is the only entity that has been proven time and time again to actually save the United States taxpayer income tax. I call it the unicorn entity. I have 2 children. My daughter's obsessed with unicorns. So I call it the unicorn. It's the fictional creature. It does exactly what you would like an entity to do. It not only separates assets from an asset protection standpoint, but it also allows you to save income tax in the process. So how does this all work? Let's say that you are a property manager, a self-employed real estate professional. You have an online sales business on Amazon and eBay. We saw a lot of those pop up during the pandemic. Let's say that you just have some sort of self-employed revenue stream. You're meeting the certain milestones of $40,000 to $45,000 net profit. You've got personal assets you want to separate from an asset protection standpoint. So we say, okay, let's go ahead and file you as an entity structure. And we choose the S corporation. Well, how does this S corporation actually save us tax? The S, let me go here really quick. The S corporation is meant to not save you federal and state obligations, but as a self-employed individual, the S corporation is the only entity that will help you reduce self-employment tax. Now, self-employment tax is the same thing as Social Security and Medicare tax. I, as a W-2 wager with Robert Hall, all of my taxes are taken out even before the money's deposited in my account, right? I am forced to pay Social Security and Medicare, but on my self-employed business side of things, if I don't offset 100% of my profit with expenses, whatever that profit is as a self-employed business owner, I pay federal tax, state income tax, and self-employment tax, which is me contributing more to Social Security and Medicare, right? So W-2, it's automatically taken out. Self-employed, you're obligated to pay it on either on a quarterly basis or at the tail end of the year when you file your tax returns. The S corporation will allow you to reduce your self-employment tax, your Social Security and Medicare tax obligation by upwards of 60 to 65%. All right. Now I've got a really unique calculation here, and then I'm going to go back a couple slides because I accidentally dropped it in the wrong place. Let's say that you have an S corporation that is generating $100,000 in net profit. So this is after all of your expenses have already been taken. You know, let's assume you made 300 grand, you deduct $200,000 in expenses, you got 100 grand in profit. As an LLC, as a C corporation, or even just as a sole proprietorship, a person who didn't want to incorporate at all, just operating under your personal Social Security number. On 100 grand, you're going to pay federal income tax, state income tax, and self-employment tax on the full 100K. Self-employment tax alone is 15.3%. At 100 grand of income, if that's your only source of income, you're looking at about 22% federal and about 8% state. So you're 30% plus 15.3%. That's 45.3%. Now you get half of your Social Security and Medicare as a write-off. So averages out to maybe 38, 39% overall in tax. Well, why the heck are you working so hard? If 38% is just going right back out the door, well, I know why you work hard, because there's never going to be a time where you pay $1 in tax for $1 earned, right? So we work to survive, we work to live. But there are unique ways for self-employed individuals as they build their independent wealth to structure themselves in different ways to help retain this wealth that you're building for yourself. Once again, what you might consider to be a tax savings helper in the tax industry, I don't look at myself as a person that saves you tax. I look at myself as a person who helps you retain wealth. It's the same thing, right? But wealth retention is a lot more sexy, I guess, right? It's a lot more interesting. Okay, I could get on board with wealth retention, but taxes are boring. I don't really care. I can save tax on my own. So we are here to help retain wealth, and keep more money in your own bank account. And then I'm going to push you to buy as much real estate as possible because I'm a real big real estate guy. But let's say that you have $100,000 of net profit through your business. Once again, LLC, sole proprietor, C Corp, you're going to pay the max tax rate. But as an S corporation, you are no longer considered to be a self-employed individual. You are now an employee of your own corporation, and employees receive what kind of pay? W-2, right? W-2, they receive a W-2 compensation payout, and that is called your reasonable salary payout. Now, under an S corporation, you don't have to take that full 100 grand and pay yourself $100,000 of W-2 income. That's the beauty of the S corporation. There's a whole part of the Internal Revenue Code that talks about a reasonable compensation plan for the professional that is operating their own business. In the real estate field, reasonable comp plans can be as low and no lower than 35 to 40% of your net profit. There are other accountants out there that will tell you 20%, 25%, but my statistic or my calculation is based on case study with the IRS, what actually flies under audit. And we've tested that 35 to 40% threshold time and time again, and it's passed with flying colors under the IRS's audit system. So 35 to 40% of 100 grand, we're using 40% in this example, you pay yourself a $40,000 W-2, and then you get to write yourself off. You get to deduct what you paid yourself. So 100 grand minus $40,000 leaves the company with leftover profit of $60,000. Now, why would you want to jump through all these hoops, run payroll, because that's a whole lot of processing fees and extra documents? Why wouldn't I just take the 100 grand as a check from my corporation, or the 40 grand is just a check? Well, once again, to be in compliance with Internal Revenue Code, you are no longer self-employed. So you have to pay yourself a salary as a self-employed business owner owning 100% of a property business. So $40,000 is your W-2. You get to write yourself off. You got $60,000 in leftover profit. And what have you just achieved in this scenario? Well, you haven't achieved tax evasion because tax evasion is illegal. What you've achieved is tax avoidance. You are properly avoiding self-employment tax / Social Security and Medicare tax on $60,000 of your company's profit. Because the 40 grand W-2 that you paid yourself, that pays federal tax, state income tax, Social Security tax, Medicare tax, state disability, unemployment insurance. So now, not only are you employed by your own business, but you have state disability benefits, you have unemployment benefits, you are paying into Social Security and Medicare, which you're obligated to do. That's to be in compliance. And what you've achieved is a tax-free benefit on the $60,000. Sure, you still pay, no matter how you split this number, when you add the 60 and 40 back together, it's still 100 grand. So you still pay federal and state income tax on 100 grand. But what you avoid, not evade, once again, evasion is illegal, avoidance is not. What you avoid on $60,000 is 15.3% of Social Security and Medicare tax. That is just shy of about $10,000 in right out the gate tax savings. It is unnecessary Social Security and Medicare benefits that you get to retain as part of your wealth and not overspend with Uncle Sam and the state agencies. All right. Now, if you're in Nevada, if you're a Nevada resident, right, who cares about state disability and unemployment insurance, so on and so forth. So this makes even more sense in a state like Nevada or Texas or Florida. So I want to flip back really quick before I dive more into that calculation, because I once again, I meant to drop this after those slides. But, you know, let's figure that if California is the highest tax state in the US and I'm going to have to pay state disability and unemployment insurance, why don't I just incorporate Nevada and pay myself as a Nevada employee? I don't not like that idea. I like your train of thought. You know, I like where your mind's sitting and, you know, you're thinking outside of the box. You know, how do I avoid even more tax, right? Not evade, but how do I avoid these additional types of taxes? Well, the state of California, much like we all probably already know, California is a very unique state. We are the highest tax state in the US. We have been for a pretty long time now. We were a close second to New York for a while there. But when you add the county taxes and the local ordinance taxes, the city tax, but when you add all that together, plus the franchise tax board tax, if you are a high income earner here in this state, you are paying the highest tax rate in the US. Okay. We pay for the rain, we pay for the sun, we pay for the 100+ degree weather outside, you know, we pay for it all. Okay. And we still have potholes in the road, so go figure. But can you incorporate elsewhere to save yourself tax? California, like I said, is unique. It is one of about 8 states that taxes its residents on their worldwide income. Not just United States income. I said worldwide income. Now, we do have tax credits. So if I pay tax in Canada, or if I pay tax in Mexico, I get a foreign tax credit here in the US. So there is a double taxation treaty with most countries across the globe. But let's talk about the continental 50 states really quick, okay? If I work in Nevada, right, work as a corporation and I pay myself as a Nevada resident, I'm an employee in Nevada, but I reside in the state of California. I register to vote here, drive around a car with California plates. I have a California address on my driver's license. By definition, under the state of California franchise tax code, I am a California taxpayer. I'm a California resident. So California, even though I earn the revenue in Nevada, because I reside in the state of California, I have to pay California state income tax. Now you can incorporate elsewhere for greater asset protection benefits. Nevada, great asset protection benefits. Alaska, great asset protection benefits. Delaware, Texas, Florida, Wyoming, Wisconsin, Utah. I mean, some of these states have great land and asset protection laws. Alaska is one of the better states for asset protection just because of all of the oil money that comes out of Alaska. So you can incorporate elsewhere for that asset protection benefit, but not to save you income tax if you are a California resident, all right? If you incorporate Nevada and you operate your business out of Nevada and you pay yourself as an employee, it doesn't mean that you are just a Nevada corporation. You actually have to file foreign jurisdiction in the state of California to register your corporation with the Franchise Tax Board and then pay yourself a salary as a Nevada employee, but still have to file it on the California return. Now, how confusing is that, right? California is going to get you going and coming. I mean, they are, once again, a very unique state. They have things like the clawback clause. When you own a property in the state of California for 15, 20 years, you decide that you're done with the state of California, you want to exchange into 15 properties elsewhere in the US. 10, 15 years down the road, you decide to sell out of all of your real estate investments. Well, California says, hey, that property originally started in California before the exchange. So the 15, 20 years that it sat here in the state of California and the tax that you avoided by doing the 1031 exchange, California is going to claw back 15 to 20 years of capital gain and recapture depreciation tax. They will follow you, okay? So just be aware that California is that unique state. You can incorporate elsewhere for greater asset protection, but not to save you state of California income tax. Just be aware of that, okay? So going back to this really quick. So once again, everybody kind of understands the 60 grand saving roughly about $10,000 or just shy of $10,000 in tax savings. The threshold that I gave you earlier at about $40,000 to $45,000 in net profit, that is not where you break even tax savings wise, but you're getting pretty close to it. You know, at about 30 grand of net profit under a corporation, that's going to save you as much tax as it costs you to file or operate as a corporation on an annual basis. So it's a wash. And at that point, it's not that you're not receiving a benefit, you're just not receiving any tax savings benefit. You're still achieving great asset protection, though, correct? Because you have the entity structure. So have this conversation with your tax advisor. Make sure that you are incorporating for the right reasons and at the right time. Incorporating is not right for everyone. I'll give you one more quick story about incorporating before I move on. I had a client come to me in 2019, right before the pandemic years, and she had gone to attorneys in Nevada, and she had just moved to California. And these attorneys in Nevada had advised her to set up 8 LLCs, a management corporation, and a living trust. And I thought, man, this client, when we were kind of dialing in the bio for this client before she came in, I thought it's going to be a big client. This is a person I can really help save a lot of money. She comes into my office with all of the articles of incorporation, about a stack of incorporation binders this tall. She's got the estate paperwork. She's got the operating corporation paperwork. And we sit down and I start talking to her about family and her business and whatnot. I say, okay, well, when did you acquire all these properties? She goes, what properties? I said, well, what properties are currently sitting in these entities? And she goes, oh, no, I set these up to eventually acquire properties. And I thought to myself, I'm thinking, okay, if attorneys told you to set these up, even though you weren't in escrow on a property, you hadn't acquired this property and you were trying to transfer title into it. This was all just preemptive, that this was premature, essentially, right? And she goes, well, yeah, and I'm trying to buy property and I look at her tax return and there's no way based on her income for last year or even in years past that she was ever going to get financing on anything substantial enough to require an entity structure. She paid $35,000 for this structure. Oh, you know what we ended up having to do because she moved to California and had to register with the state of California? We had to close them all down. We had to close them all down because she, once again, she didn't have the momentum or the direction yet to acquire these properties. And we ended up having her contact the attorneys again, and they gave her a discount on everything. And I mean, this is a whole lot, but the reason why I tell you the story is because this person was sold up the river on something that she did not need this year or the following year. She didn't need it until she actually pre-qualified for a loan, right? And figured that she was going to be buying her first investment property. And when I asked her what her plan was with real estate, she goes, well, I want to buy a primary residence first. Well, none of that means anything for a primary residence, right? 35 grand. So just make sure that you are educating yourselves, that you're working with people who aren't just going to set all of this up for you to charge you. There is very much a right and a wrong time to start this type of entity structure. That was a great structure, by the way, for the right taxpayer, not for this particular payment though, okay? Let's talk about just really quick about some top tax deductions, just so that as we move forward into the extension filing season, if you haven't filed for 2022, or just to think about for 2023. The Inflation Reduction Act had passed at the beginning of this year. A lot has changed under the Inflation Reduction Act. Because we have an election coming up in 2024, I do foresee that as we approach the end of the year and enter into 2024, both presidents, President Biden and whoever his running mate is, they're both going to want to look good on paper, right? So they're going to be talking a big game. They're going to be talking about what they would change under the Internal Revenue Code, credits that they're going to bring back, first-time homebuyer credits. You know, they're going to be bringing a lot of this information to the media outlets to try to stimulate their voter base, right? To try to increase their voter base. Well, nothing exists until it's in writing. Just be aware of that. So they can talk for days or for months about what they're going to do, but nothing is true until it's in writing. So do not make any serious or significant financial decisions based on what you hear on the news at night or what you read in the newspaper. And if you do read about something, okay, double check with a reliable source. Call your tax professionals and double check on that. Perfect example, yesterday I had a client say, email me, she's selling her primary residence in Burbank. And she goes, is it true that the Section 121 primary residence exclusion is now $1 million for married filing joint couples, $500,000 for single individuals? I said, no, that's not true. There's a bill in place to potentially increase that, but that probably won't pass until 2024, and it might not even apply or be retroactive to 2023. So here she is thinking, because she heard at, I think it was a caravan meeting, one of her associates, that the Section 121 exclusion was now $1 million or $500,000 for her because she's single, and she was going to outright sell her primary residence. So thank goodness she contacted her tax advisor, and I said, no, nothing's in play right now. I really hope that when they pass it, they'll make it retroactive for 2023. But the likelihood of that happening is very little. The retroactive stuff was a pandemic-related thing. The IRS is really not in the business to be retroactive for previous years, because who loses money in that scenario? They do, not us. They lose money. And that's not what they're in the business to do nowadays. They need to start collecting on all of those checks and the money that they were printing during the pandemic. We're going to see some very unique code changes over the next couple of years, but over the next 18 months, we're going to see a lot of fluff, a lot of smoke and mirrors leading up to the elections. Just be very aware that unless it's in writing, it does not exist from an Internal Revenue Code standpoint. But let's talk about things that are in the and that are for sure. The number one deduction for self-employed business owners during the pandemic and coming out of the pandemic was marketing and advertising. I saw a very unique correlation between this deduction and people's revenue, either increasing or decreasing during the pandemic, and also continuing on to 2022-2023. I noticed that the clients during the pandemic who saw exponential increases in revenue also spent 3, 4, 5x what they did in previous years on marketing and advertising. Well, they were sitting at home, they were redeveloping a website, they were sending out mailers again rather than doing door knocking and rather than doing in-person meetings, because people were afraid, they weren't opening their doors, right, during the pandemic. So they sunk a ton of money into marketing and advertising, merchandising, branding, so on and so forth. This is a dollar for dollar write-off for your business if you are self-employed. So make sure that you are maximizing this deduction as much as possible. That's number one. Number two, professional supplies and equipment. How many people own a cell phone in the room? Silly question, right? How many people own a laptop in the room? Silly question, right? These are some of the more common business write-offs in today's world. So the federal government allows you a dollar per dollar deduction on your internal revenue code or internal revenue service form, Form 1040 or Form 1120S, but the state of California does not allow for 100% tax write-off. So you also have to understand what the state of California limits, what the IRS allows fully, and vice versa. Just a quick example, mortgage interest is a larger deduction on the state of California side than it is on the federal side. I don't know if you all knew that, but California never conformed to the code. California still allows you the interest deduction on your primary residence on the first $1 million of debt, $750 on the state side or on the federal side. So professional supplies and equipment. Number three, car and truck expenses. Saw a lot of people buying new cars this during the pandemic. Legal and professional fees, dollar for dollar tax deductible. Last but not least, property deductions. If you're living or if you're working at home, you're going to want to take an allocation for your in-home office deduction. Last but not least, and then we'll hop into Q&A. Yeah, is that okay? Or do I have to cut it off? Okay, all right. Sorry, I get excited about this stuff. So we'll fast forward to this one really quick here. So once again, if you enjoyed what you heard, you want to learn more about what you could possibly do to help you save tax, incorporating questions, sign up for the free consultation. Easiest way is to text Robert Hall to the number 72,000 or scan that QR code, and we can connect with you on another day.
Thank you. When you have any questions, come up to the mic right here in the center.
This is William Wade from Pinnacle Real Estate Group. I got two questions. I know you didn't mention cost segregation, but my question on that is, does the deductions and credit, for example, like 179D and 45L, do they affect the way you do cost segregation?
So you're talking about, so 179D, I believe, is a portion of the code that has, it also applies to like software development companies where you can't deduct research and development costs. You're talking about what that 179D, right? Cost segregation is not on equipment or contract service type expenses. Cost segregation is mainly used, and I've only ever done it on real estate. So on like a tech company business, I've never done a cost seg election on a tech company. In fact, I don't even know if there's such a thing to do cost seg. Cost seg is mainly real estate related, and it's the ability to accelerate the future year depreciation write-offs in this current year. So if you never plan on selling the property, that future year depreciation, which includes all of the improvements to the property, it includes masonry work and the electrical outlets and the wiring and the plumbing, all of that stuff to accelerate in this year if you need the write-off this year rather than waiting 27 and a half, 39 years, depending on residential and commercial. I think that what you're talking about is maybe the Section 179 election, which is accelerating a computer or a piece of equipment deduction. Two completely different parts of the code. So cost segregation is not Section 179. Section 179 is allowing you to take this computer only on the federal side, not on the state side, because cost seg is both federal and state, only on the federal side of the 100% in the first year. California doesn't allow for Section 179. They allow for only one very small portion of the deduction each year. Section 179 is mainly for office furniture, equipment, and also bonus depreciation for vehicles. So if you purchase a new vehicle starting January 1st, you can take on a vehicle that weighs up to 6,000 pounds, you can take up 80% of the vehicle value all in the first year. That's bonus depreciation. California does not conform to that. Cost segregation, on the other hand, when you accelerate property depreciation, the federal and the state agency both accept that. So there are some significant differences in cost seg in Section 179. I don't know if did that answer some of your question?
My question is more on the bonus depreciation on any of the improvements that you may do during maintaining a property. If any of that, if you get bonus depreciation, can you still do cost segregation?
Oh yeah, absolutely. So you can do bonus depreciation on appliances, on furniture that you buy for a rental property. You can't do bonus depreciation on the property itself, though. It's not called bonus depreciation. It's accelerated depreciation through cost segregation. So once again, I think maybe I'm getting a little bit too minute in the detail of the code, but it's just accelerating future year deductions of a depreciation standpoint. For instance, a residential building has a 27.5-year lifespan, right? So the building value, not the land, but the building value has to be written off over 27.5 years. Cost segregation allows a third party to go in and analyze this single family home and take out anything that is under the 20-year depreciable lifespan. The structure itself is 27 and a half. You can't do anything about that. But if you take out the HVAC, the lighting, the cabinets, the faucet fixtures, the hot water heater, the irrigation system, and you take that out, those are all items that are depreciated under 20 years. Cost sake, we can take everything under 20 years and dollar for dollar deducted in the in that year that you're making the election. Everything else stays 27 and a half years, and land is just land. That's not depreciable. So yes, there's a mix and match that you can still do cost saving, even if you bonus depreciation.
Thank you, Tony.
Yeah.
And I do apologize. I called you Robert just a second
That's
ago.
I get
It's
called
Mr.
Robert.
Tony Watt. I saw Robert on the screen.
That's a compliment.
So I'm really sorry we are short on time. And if anybody else has any questions, if it's okay if they ask after the meeting, or they have your contact information on the screen. I think that's it from us today.
Thank you, Tony, for that really informative explanation. At this time, I'm going to introduce the person who needs no introduction, Albert Tran.
It's a wealth of information. Thank you very much. This is a very good candidate for a class, 1 hour class. So I would consider that.
Anyway, would like to special thanks to Derek Helper. Could you please stand up? Derek helped us put together a video for the association. So just give it 1 minute, you can see the word of West San Gabriel Valley.
Welcome to the West San Gabriel Valley, a thriving hub for real estate professionals. If you're an ambitious agent looking to unlock new opportunities and elevate your career, the West San Gabriel Valley Realtors, or WSGVR, is here to guide you on your path to success. As a member of the association, you gain access to a vast network of like-minded professionals. We host regular networking events, providing you with valuable connections and potential collaborations. Join the West San Gabriel Valley Realtors today and unlock a world of opportunities. Take your career to new heights with our extensive network, educational resources, exclusive tools, advocacy, and community involvement. Visit our website or contact us now to embark on your journey to success with WSGVR.
Thank you, Albert, for that quick but very interesting video. Thank you for our CEO. Good job. Yes. Also, let's get right to the nitty-gritty, the attendance drawing. Okay, all WSGVR members are included in the attendance drawing, but not all can be displayed on the. Today, our pot is $450, and if we don't get a winner, $25 is added to the pot each week until there is a winner. The pot will begin at $25. If someone wins, it'll be reset. And if our last meeting of the year, we still haven't found a winner, we will draw names until the lucky member in attendance of the meeting gets called. The winner must be in person at the association. When your name is called, you must announce that you are here present. If you do not announce yourself within 3 times, then and do not respond, well, then we will move on. Okay, no exceptions.
Winner.
The name is Arthur H. Lee. Going once. Arthur H. Lee going twice. Arthur, where are you? Not here. Okay, we'll move on. Thank you. And we'll add $25 to the pot for next week, so it'll be $475.
Okay, Amazon.
Okay, we now have 3 winners already. Cindy Yee from Remax, Council, Cecilia Boone from Caldwell Banker.
He always wins.
And Jacqueline Chow from Champion Escrow. Time for the 50.
No, it's time for education.
of education classes. Okay, let me give you the education classes real quick. The educational class zip form training is Monday, July 17th from 9:30 a.m. to 12:30 p.m. Free. Also, we have the, well, this is a very informative class, actually, how to present your offer as good as cash. Tuesday, July 18th, 11 a.m. to 12 noon, and the cost is free also. The DRE 45-hour requirement class, get yourself continuing education done, including the ethics classes, all the new classes, July 21st, 9:30 a.m. to 12:30 p.m. and the cost is $85. And virtual training HomeSnap, which is on your CRMLS HomeSnap Pro app, July 26th, 9 a.m. to 10 o'clock, and that one is also free. Okay, thank you. Yeah, this is for the 50/50, and the number is 072479. I'm looking right at you. Is that why? How much?
54.
54.
I need her name. Earl, her name,
Sandy?
last name Sandy. Sandy, last name.
Yeah.
Announcements.
At this time, if you submitted an announcement form, please come up and make your announcement. Or if you actually did not register.
The golf tournament is tomorrow. If you still want to sign up, we'll take a last minute sign up for whether it's golf or dinner. And if you can donate raffle prizes, we love to have you.
So registration starts at 12. We do need some muscles. If you want to just donate your time and your muscles, we'll be more than happy. You can join us at 10:30, 11, and please help us set up, anything and everything is appreciated. Looking forward to seeing all of you tomorrow. Have a wonderful day.
Any other? Okay. Please join us next week, July 20th, as we welcome Ross Maza, Vice Mayor of the City of Alhambra. And he will be giving us an Alhambra development.
That's it, meeting adjourned.
Okay, that's it. That's it for everyone today. The meeting is adjourned.